Here's what everyone missed about the AI trade. Institutional selling didn't start when NVIDIA hit $2.4 trillion. It started 6 months ago, in October 2025, when smart money began rotating out of AI hype and into AI infrastructure reality. Vanguard reduced its NVIDIA position by 12%. BlackRock trimmed megacap AI exposure by 8%. State Street rotated $15 billion from growth to value. While retail investors kept buying the narrative, institutions were already positioning for the next phase. But here's how you know when the sell-off ends. For indicators institutional money managers watch religiously. First, insider buying acceleration at key AI companies. CEOs and CFOs don't buy their own stock unless they see sustainable value ahead. Second, institutional flow reversal from net selling to net buying. Third, technical oversold conditions in AI infrastructure stocks trading below their 50-day moving averages. Fourth, valuation compression where price-to-earnings ratios normalize below historical bubble levels. Most investors think we're at the end of the AI revolution. Wrong. We're finishing Chapter 2 of a 5-chapter story. Phase 1 was infrastructure build-out from 2023 to 2025. NVIDIA building the highways. Cloud providers scaling compute capacity. This phase is complete. Phase 2 is the application layer explosion happening now through 2028. This is where real business value gets created. Phase 3 starts in 2029 with AI-native business models that don't exist yet. Understanding AI investing requires mapping the complete architecture stack where institutional money flows. Layer 1 is semiconductors where NVIDIA commands 80% market share with H100 and H200 chips, but AMD's MI300 and Intel's Gaudi chips are creating competitive pressure. Layer 2 is cloud infrastructure where Amazon Web Services, Microsoft Azure, and Google Cloud control compute distribution and customer access. Layer 3 represents AI software platforms where Salesforce Einstein, ServiceNow Now Assist, and Palantir AIP provide enterprise development frameworks. Layer 4 covers application integration, where traditional enterprise software embeds AI capabilities into existing workflows. Layer 5 represents pure-play AI-native applications, a category that barely exists today but will create tomorrow's biggest market capitalizations. Each layer has different competitive dynamics and investment opportunities. The chip layer faces commoditization pressure as alternatives to NVIDIA emerge. Infrastructure layer benefits from scale advantages and switching costs. Platform layer operates winner-takes-most dynamics where network effects compound. Application layer creates the most value because it solves real business problems. Smart money is rotating from layers 1 and 2 into layers 3 and 4. Separating sustainable AI companies from bubble stocks requires a 4-factor framework. Revenue visibility through multi-year forward contracts versus spot pricing exposure. Moat expansion where competitive advantages strengthen versus commoditization risk. Capital efficiency measured by return on invested capital trends. Market penetration analysis comparing total addressable market expansion against saturation signals. Companies scoring high on all 4 factors survive the inevitable shakeout. The next wave of AI winners operates in 3 distinct investment tiers with different risk-return profiles. Tier 1 includes proven infrastructure plays like Microsoft with Azure AI Services and Amazon with Bedrock Foundation models. These companies offer sustainable competitive advantages, diversified revenue streams, and defensive characteristics during market volatility. Tier 2 covers application layer leaders like Salesforce revolutionizing customer relationship management and ServiceNow transforming enterprise workflows through AI automation. These companies benefit from switching costs and network effects as AI capabilities become mission-critical. Tier 3 represents pure-play AI-native disruptors in emerging categories like autonomous code generation, AI-powered pharmaceutical research, and machine-generated content platforms. These create asymmetric return opportunities with higher volatility, but potential for exponential growth as entirely new markets develop. Professional positioning for AI's next phase requires systematic monitoring of bottom timing indicators, strategic layer rotation implementation, and disciplined bubble-prone sector risk management. Key indicators include insider buying acceleration at AI companies, institutional flow reversals from net selling to net buying, technical oversold bounces in fundamentally strong names, and valuation compression below historical averages. Successful rotation strategies move capital from saturated infrastructure plays toward emerging application layer opportunities as value creation shifts up the technology stack. Risk management becomes critical during transition periods using appropriate position sizing, diversification across AI layers, and volatility-adjusted stop losses. The artificial intelligence revolution continues expanding across industries and geographies, but tomorrow's winners will be different from today's market leaders. Professional money managers who understand layer-by-layer competitive dynamics and timing rotation cycles will capture the most significant returns. Subscribe to Premium Logic Lab for institutional-level analysis that helps you position ahead of major sector rotations and identify emerging opportunities before they become consensus trades.